Okay. All right. Let's move on to the next big story that we're tracking for you here. The Reserve Bank of India Governor Shaktikanta has warned banks and NBFCs to remain watchful of any potential stress build up during times of exuberance, asking them to build capital buffers in case of any adverse turn in the business cycle. Speaking at the annual FICCI IBA Banking Conclave 2023, Shaktikanta also asked banks to monitor their exposure to NBFCs amid increasing interconnectedness in the financial ecosystem. Ritu is here to decode what all of these big words mean. The market's meaning or the takeaway for the market was that, okay, RBI is getting very vigilant and banks decided to sell off, but that's the market interpretation. Ritu, you tell us more. What did you make of the commentary today?
Well, the governor sounded a very cautious note in his speech, throughout his speech in the second half today, repeating, like he's done before, that, in times when credit growth is high, NPAs are low, banks and NBFCs really need to introspect as to where the next potential risk could come from and therefore build additional buffers in case the business cycle turns. The messaging was very clear that they must avoid all forms of exuberance and ensure that the growth that they have is sustainable. He also noted that in certain cases, RBI has seen that there is an increased reliance on short-term, bulk deposits while the tenor of loans is getting elongated, and therefore highlighted the need for strengthening the asset liability management as well. Now, though banks are well capitalized, the governor said they should constantly evaluate their exposure to NBFCs because of the increasing interconnectedness between the two, which points to some kind of contagion risk possibility. And therefore, he asked NBFCs in turn to reduce their over-dependence on bank funding as well. Now, the governor has also highlighted that, in the case of NBFC MFIs, microfinance lenders should remember that they're catering to the marginalized clientele and therefore not charge very high rates. And he highlighted that in some cases, RBI has seen that lenders have been enjoying relatively higher margins as well. Now, importantly, he's warned banks and NBFCs of relying solely on model-based lending through analytics, especially when it comes to their collaboration with fintechs, which largely rely on data for lending. Now, he said these algorithms, they need to be retested periodically and recalibrated, and asked the lenders to be watchful of any undue risk build-up because there could be information gaps in these models. So, plenty of warning coming in, but like you said, no regulation, sure. But, as we've seen typically with RBI in the past, first comes the warning, and if the warning is not heeded to, the regulations follow sooner than later.
Oh, yes, Ritu, absolutely. We've seen exactly that play out with the unsecured lending and the credit card bit, right? I think that's why the market listened very carefully today, and we got that immediate stock reaction. Thanks very much for the highlights.
Thank you for watching CNBC TV 18, and do follow us on all our social media platforms for news, updates and more.